I am delighted to tell you the person we're going to hear from today. And in looking around the room, I see a lot of unique people, of which you're one. Some of you like the fact that I call you unique. Others of you know what I'm talking about. This individual who's speaking today is one of those unique two, one of whichever one you like. He has an aerospace engineering degree, which is entertaining. Wharton MBA, passed the bar exam and was involved in patent law for a while without becoming a lawyer and going to law school, which I find entertaining. I think that pretty well separates him from anybody else here at this moment. He has run a major business unit for Conrail, about a $100 million business unit, so he knows the real world as well as everything else. He is still does some work for the NYU Stern School of Business, where he speaks up there on corporate governance. He's been, for 21 years, a consultant primarily in performance behavior in corporations, with an emphasis, of course, on executive compensation. He has written a lot of articles. He's working on 2 books now. The one is on, sort of compensation governance, which I'm sure is going to be wonderful. But frankly, the one I'm looking forward to is the one on utopia. And so I've been looking forward to that for the last 8 years of this presidency, too. I haven't found it yet, but I'm fairly sure that Mark is going to tell us how to get there. So in addition to telling us that, he's going to talk about this subject, executive pay, what your compensation consultant won't tell you. We all know a lot of great compensation consultants who are really neat people and know what they're talking about. But I would tell you this is a guy that I look to know the ins and outs from every different side of what's going on in terms of performance versus compensation. Please welcome, from Aubrey, Texas, Mark Hodak.
Thank you. Thanks, Dennis. Much appreciate that. And I appreciate everyone who's here today. And I really appreciate the experience that most of you people, all of you people probably bring to this subject matter. I know a lot of you have thought about it a lot. And hopefully you're also here, though, not to just hear things that you already know, but to hear things that you've never heard before, and I guarantee you're going to get that today. Now, I'm getting over, just to warn you, I'm getting over a cold. The way colds affect me is they come on fairly mildly. They don't knock me out. I get, a little bit of, the sniffles and all that, but then the cough lingers for weeks. So if you see me going like, this a little bit, it's not of a nervous tick. It's just because I feel a cough coming on. I don't want to do it in the microphone and split your ears. As long as I can suck on these things, I'm good. So I'm going to be reaching for those throughout. Now, this is not going to be a typical discussion about compensation. This is not going to be about what people are doing out there, what the trends are. This is going to be focused on research. And the kind of research that I mean is the research where we're testing hypotheses or theories against the massive data of thousands of companies over decades of time. So we're going to kind of get right into it. The most important thing, when I started teaching about 10 years ago at NYU, a professor kind of took me under his wing. And I wanted to teach because I wanted to keep up with the research, and believe me, I just barely keep up with it. And he said, the most important thing about the research is not necessarily just the answers, but it's the questions that are asked. So I've put together 4 questions that I'm going to be answering for you up front that are particularly designed for people in your position to figure out how, what we're doing with regards to executive compensation. So I'm going to begin this part, 30 years of research in 20 minutes. I may go a little over 20 minutes, especially if I get questions, which I'm welcome, which you're welcome to ask. So the first question is, what is the value of equity to managers? If there's a performance period and you're going to get an award at the end of it, the award may be in cash, that's a typical bonus plan, but it also might be in equity. And if you're going to give equity awards, how's that viewed relative to cash? Just yesterday, there was an article in the Wall Street Journal about Apple and Twitter and a bunch of other tech companies trying to award equity to people well below senior management. And the article sounded quite surprised, reflecting what they were hearing from these executives, how hard it is to give equity, to give stock, restricted stock to normal employees, to clerks and middle managers. I wasn't surprised because I failed at that early in my career. When somebody gives you, say, $100 worth of restricted stock, the first thing that's going to go through your head, especially if you're not an executive, is, well, if they're going to give me $100 worth of stock, why then just give me $100 in cash? I'd much prefer the cash. And that's actually reflected all the way up the value chain. I mean, senior executives would prefer cash than stock. Stock has got, the uncertain, it's deferred. It's going to vest over a couple of years. And at the end of a couple of years, you don't know exactly what you're going to get. This is compensation risk. Investors would never accept additional risk without the prospect of a higher reward, and neither will managers. So if you're going to award stock in lieu of cash, you're going to have to award more of it. It's going to have a higher value. The other thing is, at least at the senior management levels, there's a sense that they have some control over the stock price. It might not be that much, but over time they have some impact on it. You get below the level of senior managers, the attitude of people that you're giving stock to is you're basically paying them with a lottery ticket. So for those reasons, and these findings, and all these findings are backed up by just tons of research, as you can guess. So for this reason, the implications of these kinds of findings is if you're going to award equity, it really is just better to focus on the C-suite, on the top managers, the people who feel like they have some line of sight between their behavior and what's going to affect the stock price. Now, equity, we make a distinction between equity as an award versus equity as an incentive. And a lot of times these things are kind of conflated. If you're getting equity at the end of a performance period, that's equity as an award. And then once you have the equity in your portfolio, it presumably creates a sense of alignment between you and the owners, the shareholders, because the value of the stock price is impacting your personal net worth. So the next question we ask is, what is the value of management having equity to the investors? This question has been asked since the time equity became a popular compensation tool. And researchers began with a framework that said, well, as managers own more of the company, that should be better for the shareholders. It's based on the agency theory of corporate governance, that managers and shareholders have overlapping interests, but they're distinct interests. And the way we try to bring those interests into closer alignment, well, the most obvious way, is through direct board oversight. The board of directors is there to make sure that the senior executives are acting in the best interest of the shareholders. But the other way we do this is through incentive alignment by having them own a piece of the company, because that will also create that overlap of interest. The people who began studying this, though, realized that up to a certain point, when managers begin to own too much of the company, the alignment effects can begin to get outweighed by the entrenchment effects. Managers at some point have so much control that they're beyond the sanctions of the shareholders. And they can begin treating the company in a very parochial way, and if it doesn't help the shareholders, then that's too bad. Well, about 30 years later of research on thousands of companies and dozens of countries around the world, we pretty much filled that curve in, and it looks a lot like this. So in fact, the more of the company that managers own, the better it is for the shareholders, up to about 30 to 40%, and then beyond that, the entrenchment effects begin to outweigh the alignment effects. This shouldn't be surprising, I think, to anyone here, but again, there's just a ton of research that has built this graph up now, and now we know. Well, in more recent years, there has been a refinement of this alignment theory. And that's based on this idea of wealth leverage. How much of the executive's personal net worth is tied up in the value of the company? And the idea is that if we have a lot of our net worth tied up as a CEO, then my net worth is more sensitive to the value of the company, and that's going to create a sense of alignment as well. The problem with wealth leverage as something to study is harder to study. I mean, we can look up in any proxy statement and know exactly what percentage of the company the managers own, but we don't really know what the personal balance sheets are of all the CEOs to know what their wealth leverage is. So that's a problem for outsiders. The good news is it's not a problem for directors. In fact, quite a number of PE firms are now requiring their CEOs to buy 25% of their personal net worth into the shares of the company. Now, how equity is granted turns out to matter quite a bit as well. If you're going to award equity to management, there's a variety of ways you can do it. You can award it upfront in a mega grant with vesting over some period of time. You could award it on a service basis, a certain number of shares every year, or on a fixed value basis where you're awarding, say, $100,000 worth of equity, and we back into the number of shares depending on the stock price year after year. Well, it turns out that this fixed value grant poses a very significant problem that's invisible to a lot of people. I have an example here where you've got a stock price that's going to go from $20 to $30, and we're awarding $100,000 worth of stock year after year to the executive. Now take a look at this, and look at, you got the green line which goes directly up, and you got the red line which kind of takes a very deep dip before getting back up to $30. Now, as shareholders, which of these two paths would you prefer the stock price to go in? Which would, if you had a choice of which one you'd pay more for, which of these two paths would you pay more for if you had? Huh? The green, right? I mean, who needs the volatility, okay? But if you grant $100,000 worth of stock and options, would you be surprised to know that the red path ends up paying the management twice as much? Because as the stock price is going down, they're getting rewarded, in a sense, with more shares. And as they're getting more shares, when it recovers, they make it all back and then some. And it actually hurts the shareholders to do it this way, relative to other ways of granting equity. Okay, the findings of the research is that, yes, higher ownership or higher wealth leverage unequivocally leads to greater value. In fact, this is such a powerful result and a robust result in the research that if you had to know just one thing as an investor about the relationship between management and the company, you would want to know how much stock do they own. Because that results in the greatest bump in terms of your value as an owner. And the implications are that the best way to award equity is in an upfront mega grant that's going to be dished out over time, because that exposes management to the greatest amount of equity sooner rather than later. And in fact, most private equity firms, that's exactly how they grant equity to the management. Public companies, unfortunately, a lot of them grant equity in the worst way, which is on a fixed value basis, service basis year after year. Equity has been very popular for about the last 25, 30 years now, and the vast majority of the equity early on that was being awarded was stock options. Stock options are a very attractive form of reward, especially if you're trying to create higher alignment between the managers and the owners. Because if you're going to award managers equity and you have a choice between stock or options, typically you can award 3 options or 4 options in lieu of 1 share. That's the same value that the shareholders are giving up. And if I'm getting 100,000 shares of stock, then for every dollar that the stock price goes up or down, I'm gaining or losing $100,000. But if I've got 3 options and I happen to be in the money, for every dollar the stock price goes up and down, I'm losing or gaining $3. And that's more powerful. That's going to create greater alignment. The problem with options, though, is that they could go underwater. And when they go underwater, and there's no hard data on this, excuse me, but probably about half of all options awarded in the last 20 years have at some point been significantly underwater. And a real large proportion of these options are going expired or they're being forfeited before they have a chance to be in the money. When you're faced with underwater options as a director, you basically have 2 choices. The first is that, too bad, so sad, that's what we granted you, they're underwater, take your lumps. Fair enough. But the problem is that it doesn't just hurt the managers, it also hurts the shareholders, because when the shares are dramatically underwater, the reason you gave options to begin with was they had a retention value and they had an alignment value, and those things evaporated when the options went significantly underwater. So the shareholders have lost that. If you want to regain that, then what you could do is either reprice the options or reissue them or exchange them, so they now have at-the-money options. And that gives back the retention and the alignment value of the options, but that tends to be really unpopular with institutional investors, with their proxy advisors, with the media especially. In fact, the world has come to demonize repricing or exchanging of options. And ISS actually has 6 criteria. They say if you do these 6 things, we'll go ahead and approve, we'll vote in favor if you're doing it. But these are 6 things that no company can really do. I mean, the first one is you can't have your senior executives involved in this exchange. And these are the only people that are really worth giving a whole lot of equity to. But let's think about this conceptually for a moment. If we did a value for value exchange, let's say that I exchange 100,000 of your options that are way underwater for 20,000 options that are now at the money. And the value of the 100,000 that we're canceling was the same as the value, the Black-Scholes value of the 20,000 that we're giving you. What's happening now? What's happening is the shareholders are getting back some retention benefit from the newer options that they didn't have earlier. They're getting back significant alignment benefit that had been gone in the previous underwater options, and they're getting those at no real cost, no economic cost to them. It sounds like a win-win, right? Well, a lot of research has been done on this. So what does the market say? Well, the market has an interesting verdict. As institutional investors say with their mouths, we don't like option repricing, they say with their money, we're bidding the value up when you do it. Option exchanges add value to the shareholders. And in fact, the more you bust ISS's guidelines, the more value they create. Now, this disconnect between proxy advisor guidelines and what the research says is going to be a theme I'm going to touch on a little bit later. But for now, the lesson here is that the market is showing clearly repricing or exchanging underwater options is good for the shareholders. And the implications are, one of 3 things. One is, if you have underwater options, go ahead and reprice them if you need to. The proxy advisors will hate you for it, but your shareholders will actually end up bidding your company up for it. If you want to avoid the possibility of underwater options, of course, you can just issue restricted stock instead, which is a trend that has been going on in a very big way over the last 10 years, partly because the value of options is perceived to be very low after a generation of managers have been kind of screwed by getting options that end up not being valuable, but partly because boards of directors are tired of dealing with underwater options, and if you issue stock, that's like an option with a 0 exercise price. It can't go underwater. There is a third implication. We've actually created for some clients a phantom equity that resembles an in-the-money option at the time of the grant. Now, you can't grant in-the-money options directly because you've got accounting and tax rules that make that prohibitive. But we have created a phantom equity that mimics in-the-money options, and very difficult for them to go underwater. By the time they go underwater, you've got probably much bigger problems than retention risk of your management team. All right, the fourth and final question that we're asking, remember in that earlier chart I had what happens before you issue the award, the performance period? And that could be award in terms of cash or in terms of equity, which is, by the way, if you've got a performance period, a bonus plan is issuing equity as a result, isn't that indistinguishable from what we're now calling performance-based equity? Equity that you're getting based on some performance beforehand. But what happens, we talked about the value of equity once it's awarded is there, but what about how we make awards, cash and equity awards? This has been studied for a long time, and up until about 1999, the verdict of the research is that management incentive plans do not add value. Okay, I'm going to repeat that. I'm a person who sells incentive plans for a living, and I'm telling you that the research through 1999, it actually persists to this very day, say that on average, bonus plans, incentive plans do not add value to the shareholders. Now, what happened starting around 1999-2000 is you had some apoplectic people like me going into the research and saying, maybe can't we unpack this to see if there's certain features of incentive plans that might add value versus the other ones that undermine value. What we started looking at were different kinds of incentive plans, lots of different ways, and what settled out was that plans that had multiple measures driving the bonuses did not add value, and in many cases, they undermined value. And plans that were based on a single measure of performance, that measure was almost always profit or some version of profit or earnings, did add value. And it didn't matter if the awards were in cash or in equity. The research said that we're indifferent to that. And it didn't matter if you were making these awards based on one bonus plan or two bonus plans, say a short-term plan, a long-term plan. In fact, the research shows that companies that have long-term plans as well as short-term plans, and long-term plans are typically 3-year periods, did not outperform their peer companies without long-term plans over 3-year periods. They didn't necessarily do worse, but they didn't do any better. Yeah.
And those companies, do they really distinguish on the metrics between a short-term and a long-term?
Well, if you have two plans and you've got two different metrics for those plans, you've got multiple metrics. That's the way the research looked at. If you had one metric in the short-term plan and the long-term plan, if you're using, say, earnings for both, those worked out okay. That gave management a focal point, apparently, that worked out. Yeah?
And so all these bullet points are value to the shareholder.
Value to the shareholders. All this is looking at compensation practices, how they impact shareholder value. And by shareholder value, I'm talking about total shareholder returns over time, just to be clear. Yeah? Most of these are S&P 500 size companies, but this was also looked at internationally. So we're talking about generally fairly large companies, and they're all public companies, obviously, because those are the people that we have the data on. Now, that research was actually used by at least 2 hedge funds, and one hedge fund created a screen based solely on buying single metric companies and selling multiple metric companies. And this is the results of a live portfolio over the 3 years that they had this in place. The research predicted 3 to 4% per year alpha outperformance if you did that strategy, buying single metric firms, selling multi-metric firms. These are the actual results, and the actual results averaged about 3.2% per year over the whole 3-year period, and it was fairly steady up. One of the very few times that I know of where governance research using back-tested data actually converted into real money made in the investment world. So that's the research in a nutshell. And so what I'm going to do now is go on part 2 to begin to unpack the single metric versus the multi-metric